Well, Nicole, I think you start looking at the premium subscriber base. It grew about 12% last quarter, basically about 269 million premium subscribers. So that's going to be one of the key metrics that people are going to look at. Their growth overseas, because that's kind of the untapped area where they're focusing on, is their international growth. And then their monthly active users are above 670 million people using the free and premium combined. So you start looking at those numbers. Do they raise prices? This is one of those subscriber bases that kind of mimicking what Netflix did on the video streaming side, where it's hard to drop this type of subscription. And I think that's their retention rate is in the high 90 percentile. So you start looking at the premium subscribers. I think that's going to be key moving forward, and their growth on the international side of their business. I think those are two of the key things that investors should be focused on going into this report.
Okay. We talk about this as a subscription service. They have premium. They have ad-supported. So many folks love Spotify. How do they continue to grow this subscriber base?
Yeah, I think you take a look at maybe there's a little bit of saturation here in the U.S., but if you look at the premium subscribers versus the monthly active users, getting people up to that premium subscription level as they can, freely increase prices, I think is key. In the international segment, a lot of the free and ad-supported users there. So there's some opportunities as they kind of move into different countries around the world. And with the population growth, you expect those things to continue. Now you start looking at the margin side of this. Do they not, if they increase, subscription prices, do they not increase what they're paying, the talent that are providing all the streams? So those are two of the key things, and they've actually been cutting costs also, and that's been beneficial to the stock. Now, you look at the gains that we've seen so far this year, 55% gains. It's only about 10% off of those all-time highs that we hit last month, so expectations are high. It's got a small share float, so it does have that ability to move, post-earnings.
All right. Tom White, thank you. I know you've had some example trades that you'll be sharing with us as well. I want to speak with Ken Leon here of CFRA, see what your thoughts are on this name, which hit a high of 785. It's off of that, but I'm seeing some price targets even 800 and higher. What do you think here, Ken? Good morning.
So we get them tomorrow. I mean, this stock has had a parabolic move up to even like 760. It has pulled back, which I think it should. The consensus has had target prices below 600. Probably we're at 640. So they have to hit a print, Nicole, of revenue growth above 17% just to get this still in a positive trend. They don't have any press releases from the last earnings release, so it's always kind of cryptic, how much performance we can get out of Spotify. It's obviously on fundamentals just a very, very exciting story, strong business model. No one can really compete head-to-head with them, maybe YouTube. Investors obviously are looking at this anxiously, and it's one of the largest market caps in the European equity market.
So at 707, is this stock a buy?
We have a hold recommendation. We have a 695 target. We raised our target courageously higher back a few weeks ago. And, again, the street has been stubborn on this because it's hard to put pencil on paper and come up with a logical target price, if you will, way above where the stock's trading today. It's just there are some unicorn stocks like that. But obviously fundamentals are going to matter here, we think, and that's why I speak about revenue growth.
You said YouTube may be a competitor, so it won't be Apple Music and it won't be Pandora and I guess not your local radio station either. Is that right?
Yeah, so Spotify has been brilliant in terms of investing heavily in a global platform. It gives them algorithms to not only put out music for local country, but personalization. Ted Sarandis, the co-CEO of Netflix, has been on the board of Spotify. It's a similar story as Netflix. The question is, for what the business that they have, can they execute and get the growth of the total addressable market as they have? So very different than the names you mentioned, because this is their core business and they're doing a great job.
Okay, and then last but not least here, they talk about monetization opportunity in the upgrade from Oppenheimer. Is there a monetization opportunity, and how much? Because right now your price target is lower than the current value. Maybe the picture can change.
Sure, but there's 39 analysts that cover this stock, and the consensus is 639, Nicole.
All right. Any other favorites, buy ratings that you have today that you're really pounding on the table, Ken? I don't want to leave them out.
Netflix, we like Disney. We like TKO. Last week we initiated coverage on Formula One Group, FWN.K. Love these stocks, all four of them.
Hey, all right. Ken Leon, great to chat with you. Thank you so much always. Ken Leon of CFRA. Thank you. Now we bring Tom White back. We just were talking about Spotify. You gave us some of your thoughts. He gave us his summation. Now we have some trades that you're going to share with us. The first step would be a more neutral trade, right, Tom?
Yeah, kind of setting up with Ken's outlook here for Spotify post earnings. He's got that $695 price target. So implied volatility levels elevated going into this report. The option market's priced in about a plus or minus 8% move either way, about nearly $60 in either direction. As I mentioned before, it doesn't have a large share float, so you've got to be careful as far as movement post earnings on this one. But I looked at something neutral here. If you think the stock's going to consolidate at these levels, this is a short iron condor where I can take advantage of the higher implied volatility levels that we're seeing in the option market. Going out to the August 1st weekly cycle, so just 4 days to expiration, really short-term positioning. We're going to sell an out-of-the-money call vertical. We're going to sell the 750 strike call, buy the 755 strike call, so a short $5 wide call vertical. And then pair that with a short put vertical on the downside, sell the 640 put, buy the 635 strike put. So giving yourself a little bit more room to the downside here in case it does fall post earnings. You're going to collect roughly about a $2.30 credit on that. You might be able to collect $2.50, maybe even $3 on this. But if you collect a $2.30 credit, that's how much you can make on this trade. You know, you want it to kind of consolidate at the current share price. You want it to remain above the break even of 637.70 on the downside. And the upside, you want it to stay below 752.30 on the upside. About $270 in risk, but that's all the way below 635 on the downside and all the way above 755 on the upside. So if you think the stock's going to consolidate post earnings and you want to take advantage of that higher implied volatility level, this strategy takes advantage of that.
Right, understood. Okay. How about a more bullish example trade? As you know, I'm glad you gave us a neutral one because you did have Ken Leon with a hold rating and a 695 target. But now you also have a bullish example trade that you're going to share with us. Tell us more about that.
Yeah, it's a little bit neutral to bullish on this one, where you're still giving yourself some downside exposure also. You just don't want it to fall out of bed and maybe fall 2 standard deviations or something outsized move to the downside. So I looked at an unbalanced or broken wing put butterfly here, where I'm actually going to take a credit in on this trade. So going out to that same August 1st weekly cycle, so really short-term positioning on this one. We're going to buy one of the 670 strike puts out of the money to the downside, sell 2 of the 665 strike puts, and then buy one of the 640 strike puts. So in essence, you're buying $5 wide put vertical and then selling basically about a $30 wide put vertical to offset some of the costs, creating a credit of about $6.50, right? So that's what you can make above 670 is you just get to keep that credit that you collected, $650 per spread. But you can see here from the risk profile, I've got a little kicker around that short 665 strike. That's where you're short 2 options. Now, if you collect that 650 credit, it takes your break even down to 653.50 over the next 4 days. That's about 7% below the current share price in Spotify. So you've given yourself that big cushion. You just don't want it to fall out of bed and go below that 640 level. That's where you have max losses on this type of strategy, but it still gives you upside exposure with that little kicker right at or near that 655 level.
Okay. Tom, great to see you. Thanks for all your help today on Spotify, and always Tom White. Thanks, Tom.